Companies don't usually collapse overnight, and when they do, it's rarely because of a scandal or a catastrophe. Sometimes, collapse begins with something quieter, a single decision that doesn't even feel dramatic at the time. No alarms, no headlines, no outrage, just a shift small enough to ignore, yet large enough to redirect the future. This is the story of a $7 billion company that didn't implode in a moment. It drifted into its own collapse after one subtle decision. At its peak, this company wasn't just successful. It was admired. It built products people trusted, not because they were flashy, but because they worked. Customers didn't obsess over the brand. They relied on it. It lived in a space where reliability mattered more than hype. And for years, that made it unstoppable. Growth was steady. Margins were healthy. Competitors respected the boundary it created around itself. The market didn't choose the company because it was exciting. It chose it because it was dependable. Dependability became its identity. And identity for a company is everything. But identities create vulnerabilities too. Because when a company believes too strongly in what it is, it becomes blind to what it could become. And, more dangerously, blind to the quiet forces changing around it. The decision that would eventually collapse the company didn't look like a mistake. It looked like an upgrade. Leadership decided to optimize, not for quality, not for customers, but for efficiency. The reasoning made sense. Slower processes would become faster. Manual oversight would become automated. Variability would become consistency. Investors loved it. Analysts praised it. The board congratulated leadership, and employees assumed nothing would change where it mattered. But this quiet decision contained a hidden exchange. Judgment for metrics, craft for scale, discretion for framework. The company didn't know it yet, but it had traded friction, the kind that forces deeper thinking, for smoothness, the kind that silences dissent. At first, everything improved. Output increased, costs decreased, delivery accelerated, dashboards glowed green, quarterly reports impressed the board, charts went up and to the right. Optimization rewards itself. It creates proofs. It generates applause, and applause makes questioning feel unnecessary. The quiet decision now felt validated. It confirmed leadership's vision. It confirmed investor expectations. It confirmed that efficiency was the right direction. But efficiency always asks for more, and systems that reward efficiency rarely stop once they start. As optimization expanded, another shift began, subtle but damaging. The company stopped listening outward and began listening inward. Customers weren't ignored. They were summarized, simplified, quantified. Feedback became data points. Data became dashboards, and dashboards replaced context. The company could still hear customers. It just couldn't understand them the way it once did, because understanding requires friction, and friction had already been optimized out. Over time, the company redefined success without announcing it. Success no longer meant reliability. It meant scale. Success no longer meant trust. It meant throughput. Success no longer meant customers stayed. It meant systems worked. What couldn't be measured lost influence. What couldn't be graphed lost priority. What couldn't be extracted lost justification. The company didn't abandon its identity, it automated it. And automated identity is fragile, because identity requires interpretation, and interpretation requires judgment. The company believed it was improving, but improvement isn't always progress. The first signs of drift didn't appear in the market, they appeared in the culture. Engineers stopped debating edge cases. Designers stopped asking difficult questions. Product teams stopped saying no. Disagreement became inefficiency. Curiosity became delay. Resistance became risk. Meetings became shorter. Presentations became cleaner. Updates became faster. Everything was smoother, and smoothness felt good. But smoothness without friction creates blindness, and blindness without awareness creates inevitability. Eventually, customers noticed something, not failure, fatigue. They didn't complain loudly. They didn't protest. They didn't switch immediately. They just felt something was missing. The product still worked. The company still delivered. But the emotional connection, the trust that once made customers loyal, had weakened. This is how collapse begins, not with rejection, but with indifference. Indifference is quieter than anger, but it's far more dangerous. Anger means people still care. Indifference means they've already left emotionally, even if they haven't left financially yet. The company misread this signal. It saw stable revenues. It saw returning customers. It saw operational efficiency. It didn't see the erosion underneath, because erosion doesn't change the shape in one moment. It changes the trajectory over time. While the company optimized internally, the market evolved externally. not with revolutions or breakthroughs, but with small, compounding changes. Competitors tested new incentives and discovered that customers responded to things the company no longer valued. Startups entered quietly, not trying to outperform the old guard directly, but to reframe expectations around what good meant. Customers didn't demand more, they simply stopped tolerating less. The world didn't suddenly accelerate, it recalibrated. And because the company had optimized for yesterday's equilibrium, it couldn't perceive tomorrow's. Optimization narrows vision. It trains organizations to excel at detecting deviations within the model they built, while making them blind to the fact the model itself is drifting. Drift doesn't appear on dashboards. It spreads through assumptions. The quiet decision that once seemed visionary now became irreversible, not because it couldn't be reversed, but because reversing it would contradict every narrative the company built around progress. To undo it, leadership would need to willingly reintroduce the very frictions they had spent years celebrating, the removal of friction that demanded debate, negotiation, and judgment. But organizations optimized for speed resist reflection. Teams resist anything that slows momentum. Investors resist anything that threatens compounding returns. The decision wasn't just policy anymore, it had become architecture. And architecture doesn't retreat gracefully. It defends itself through inertia. The system didn't need to be right, it only needed to be consistent. Collapses rarely announce themselves. They reveal themselves. The reveal began externally, not through scandal, but through migration. Some customers switched to competitors. Others reduced usage. Others simply stopped caring. The company noticed too late. By the time data confirmed the trend was no longer reversible. Churn lags sentiment. Sentiment lags experience. Experience lags decision. And decisions, especially quiet ones, compound silently. The collapse wasn't dramatic. It wasn't cinematic. It was statistical. Declines across dozens of small metrics that once seemed insignificant now aligned into a pattern. And that pattern revealed the truth. The company had optimized itself out of relevance. This is what makes quiet decisions dangerous. They don't break things. They redirect. They don't provoke resistance. They numb it. They don't disrupt identity. They dissolve it. The $7 billion company didn't collapse because someone made a reckless bet. It collapsed because someone made a reasonable one without realizing what that decision replaced. The market didn't punish failure, it punished misalignment. And misalignment is almost impossible to detect from the inside when everything still looks efficient. The decision that killed the company was the same decision that made it look stronger. From the inside, it felt like momentum. From the outside, it looked like confidence. But systems rarely collapse when they stop working. They collapse when they keep working long after the world has moved on. Nothing failed visibly. Nothing broke publicly. The company just didn't notice that what once made it competitive had quietly become outdated. Its strength became inertia. Its optimization became rigidity. And by the time the world stopped caring, the system was still running, flawlessly, in a world it no longer influenced. If this breakdown helped you see how collapse can begin long before failure is visible, support Inside the Numbers by liking this video, sharing it with someone building at scale, and subscribing for more. Because the most dangerous failures don't happen suddenly. They happen quietly, and they look like progress until they don't.